The three biggest mistakes stock market investors make. Many of you guys enjoy when I do those mistake videos and learning videos and other kind of tutorials. So I put together a playlist of the most popular videos I made, especially this one around valuing growth stocks. It's going to be very beneficial for a lot of value investors that struggle with valuing a growth company because it looks expensive. Maybe you're not using the right metrics and the right methods. And as a former 100% value investor, this is something that I struggled with. And I think those videos, you'll enjoy them and they will help you very much. And they're free on YouTube. So again, hope you enjoy it. But I think this one is going to be a little bit special because I'm going to talk about three main mistakes that I see a lot of investors making, mainly in the comments. And I used to be that person. I made the same mistakes. I used to ask the same questions. But then over time, I missed out on so many stocks and did so many things. And I learned the hard way that it wasn't actually the market. It was actually me. I was thinking about it the wrong way. And that's how you improve as an investor. You have to be hard on yourself and analyze everything you did, and you could learn from them. And in this one, you're going to learn from my own mistakes and from my own experience instead of you learning it the hard way. So I really hope you enjoy it as always. Now, the first one, and this is by far the most popular one, the most common question I get anytime I talk about a stock is, what's the moat? But what is the moat of the company? The company has no moat. What is the moat of SoFi? There's so many digital banks, and anyone can pretty much have an online bank. So what is the moat of SoFi? What is the moat of Robinhood? You could trade stocks on Fidelity. You can trade stocks on Webull. You can trade stocks anywhere. So why does Robinhood have a moat? Why could it even be a buy? What is the moat of HIMS? HIMS is just a website, guys. It just makes a website. There's a lot of websites, so HIMS has no moat. Now, the truth is, if you approach every growth company asking the question, what is the moat, you're going to pretty much miss out on one of the best gainers in the entire stock market. And the main mistake you're making is you're valuing and you're assessing a company in its hyper growth stage, in its early stage of the business cycle. The same way you're assessing a company like Costco, which is near its capital return or maturity. You can't do that. This is a big difference between a company in its early stage and a company in late stage. So if you ask the question for the young company, what is the moat? It has no moat. I'm skipping it. There's nothing wrong with that. But you're going to miss out of them because you're valuing it and you're thinking about it the same way you would think about a company like Costco. Now, the truth is, when Costco was starting out, it had no moat. All those companies, they start with zero moats, not even a single moat. And the moat gets developed over time. So when a company approaches its capital return or maturity stage, then you can see the high margins, you can see the operating leverage, you could see all those things. You're like, oh, this company has a moat. I like this company. But maybe this company 30 years ago had pretty much little to no moat. And this is the best gains of the company happens when it goes from stage 2 to stage 5. So you cannot look at a company in stage 2 the same way you would look at it in stage 5. So what should you look for instead? You should look for TAM and competitive advantage. So when I'm looking at a company in the early stage, I have to look at the TAM, total addressable market. If the TAM is large enough, and if the TAM is growing, if the market is growing, then there's room for multiple players. HIMS does not have to have 100% market share. SoFi and Robinhood, they don't have to have 100% market share. The TAM of banking is $1 trillion and finance in general, and they're taking market share from Bank of America, from the traditional banks that charge statement fees. So now we have a large TAM, which is very important. The second thing we look at is a competitive advantage. So this is not a moat, but it starts with a competitive advantage, and maybe over time it develops into a wide moat that everyone can see. So a competitive advantage is something that somewhat differentiates the company from its competitor, that allows it to at least maintain a certain market share in this TAM. So let's say the TAM is growing 20%. If, for example, SoFi can have 10 or 15% of the TAM, if they have enough competitive advantage for that, then SoFi is going to do extremely well. SoFi does not need to have a moat. What is the competitive advantage of SoFi, just as an example? Maybe it's their branding power. Maybe people know SoFi. They know SoFi Stadium. Can any company just come in and start advertising and have their name as popular as something like SoFi? Maybe not. So maybe brand recognition could be an advantage for SoFi. Maybe the fact that it's the only app that has student loans and everything you could want all within one app. Maybe this is also a competitive advantage that's not going to allow it to take 100% market share, but it's going to allow it to be competitive against other players in a largely growing TAM. what is the TAM, what is the competitive advantage, let's say, of maybe Robinhood? Robinhood's competitive advantage is that it's very easy to use. It's a first mover advantage. They have branding power and they have other things that allows them to be competitive in a growing TAM. What is the competitive advantage of HIMS? Let's say HIMS is just a website. HIMS also was an early mover, so people know HIMS. HIMS has the money to advertise on the Super Bowl, and it's a very well-known company, and they know the names, they trust the name. There's tons of reviews. So maybe this is a competitive advantage. It's not a moat, but it's a competitive advantage that ultimately gets into a moat. And the truth is, you don't need a moat if the TAM is large enough and if the company has some kind of competitive advantages against its customers. And if you're skipping the company just because it has no moat, there's nothing wrong with that. But if you're looking for a growth stock, the moat, you're not going to be able to see it when it's starting early on. The moat will develop later on. So what you should look for instead is a large TAM that's growing and a competitive advantage that allows the company to take a certain piece of the TAM. For example, if HIMS has a 5% market share of telehealth, which is going to be a $700 billion market, and you run the numbers, which I did, the company could 10x from here. They don't need to have 100%. If they have competitive advantages to have 5% of a large TAM, then this is enough. So the truth is, moat is the most misused word in the market, the most overused word, and not every company is going to have a moat. And if your strategy is only to invest in moats, there's nothing wrong with that. But if you're trying to apply like a Pepsi analogy to a growth company, it's early stage, you're going to miss all of them because you're not going to see a moat, but you're going to see a large TAM, competitive advantage, fairly priced relative to the growth, which I explain a little bit more in my video on how I pick explosive growth stocks, and you can watch it. Now, this is the second one, which I get all the time, but the PE is at 100. So if you go on, for example, HIMS and Hers on Yahoo Finance, the PE is at 53 times, but you're showing me a chart that the PE is at, let's say 35 times. There's a big difference between 55 and 35. Or sometimes if you look at Yahoo Finance, it would show you that the PE is at 100. But yet the stock keeps on going up. Like AMD's PE was at 100 at 98. Now it's still at 100 on Yahoo Finance and it's trading at 160. So this is the big one, is the PE is too high. But the biggest mistake with that is if you look on Yahoo Finance, it would show you trailing 12 months earnings, which is great, again, with a lot of value investments and a lot of mature companies. But with the growth companies, you cannot be investing in the past. You have to invest in the present and try to invest in the future, which is why I like forward PE. And I know the challenge with that is that maybe no one can predict forward earnings. But this is when you look at the company's track record, like HIMS has a history of beating like 11 out of 12 quarters. So you could say, okay, maybe I can somewhat trust those numbers with the forward PE. So the forward PE to me is key in terms of assessing a growth company, because I don't want to invest in the past with a company that's growing. I want to invest in the future, and forward PE is important. But what's also important is the forward PE being non-GAAP. So I use non-GAAP numbers, which is mainly for stock-based compensation, and it adjusts one-time expenses. So let's say HIMS had an acquisition, they had some one-time expenses. The non-GAAP, the GAAP PE would show up at 150 because net income was low, but those are one-time expenses, so you need to adjust for them, and the non-GAAP PE adjusts for one-time expenses, which is why I like the non-GAAP PE. Now, the only problem with that is, let's say stock-based compensation, it's just a lot of it. And if you're using, again, non-GAAP, you're not using Benjamin Graham's GAAP PE on, something like a growth company. But the problem with stock-based compensation, it's bad, it's dilutive, but you have to look at the trend. Like HIMS, for example, stock-based compensation was way above net income. Now net income is above stock-based compensation. So it's getting better over time. As long as it's getting better, I feel comfortable using a forward non-GAAP PE, which makes the Yahoo Finance trailing GAAP PE like you're investing in newspaper, and now we have the internet. It's kind of the same thing with growth stocks. You cannot invest in the past, and if you use GAAP numbers, you're gonna miss out on Nvidia, you're gonna miss out on AMD, you're gonna miss on every single one, because all those tech companies are, benefiting from stock-based compensation. And to adjust for all those things, you have to use non-GAAP PE ratio, which you could find on Ticker, you could find pretty much anywhere. They have the non-GAAP forward PE, which I believe is key into assessing a growth company. And again, if you look at just GAAP numbers, there's nothing wrong with that, but you're gonna miss out on every single tech stock that has done so well. And maybe there's a reason for that, and I just explained to you the reason. Now, the third one, which isn't really the most important one, but I wanted to talk about it, and maybe this is again a common mistake with investors, is buying the second best because it's cheaper. So we look maybe at something, I don't know, maybe CrowdStrike, and CrowdStrike is expensive, but we have a second best, maybe, I don't know, it's Zscaler or some kind of other company. It's the second best, but it's cheaper. So you want to buy the stock that's cheaper. When you do that 95% of the time, you're going to underperform the company that is a leader. So most of the time, it's best to buy the leader, pay up for the leader, instead of buying the second best just because it's cheaper. Now, I still do this personally, like I bought AMD instead of NVIDIA, but I did that in 2024, and there were bad sentiment around AMD. But let's say we have a bear market and all the stocks are going down. You generally have to pay up and buy the leader, even if it's trading at a premium to the second best. And you will see over time that, maybe AMD and NVIDIA is a good one, and there's a lot of them, where the leader will outperform the second best, even if you pay up for the leader. It's a leader for a reason, and it's best to pay up for the leader than buying the second best. This is something I learned the hard way, but I see a lot of investors where I tell them about a stock, they say, okay, you like HIMSS, but there's LifeMD, which is younger and it's cheaper and all those things, or you like Constellation Energy, but there's this other one that's it's not as good as CEG, but it's also good and it's cheaper. You will most likely underperform. It's best to pay up for the leader and just let it ride. And I learned this the hard way, and I used to try to find the second best and third best. And I do this sometimes if I see the right setup from a bad sentiment. But generally speaking, whatever industry you want to bet on, chips, maybe NVIDIA is the best. Maybe cybersecurity, maybe it's CrowdStrike. Maybe it's other stocks in certain industries. But it's generally best to buy the best one instead of buying the second best just because it's cheaper. And I know sometimes it works, like, Visa and MasterCard. You could have maybe Lowe's and Home Depot. Sometimes it works, but most of the time, it's best to pay up for the best. And that's just my opinion for today. And I gave you a few things. Hope you enjoyed them. Hope you learned something. If you disagree with me, let me know down in the comments. But I'm just showing you things that I've done over time and they work, and I try to share them with you. So hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.